Sassman here with Century 21. That's Scott Swinford with Hancock Mortgage, and it's another Mortgage Tip Monday.
It is.
So, we got a very important thing that a lot of people have misconceptions about, and that's your down payment. The most common thing that people think is you have to put 20% down. I can never afford a house because I have to put 20% down. And that can end up being a lot of money. But guess what? 100% not true.
Exactly. Yeah, the hardest thing about a down payment, at least in my opinion, is deciding whether it should be one word or two.
Mm-hmm.
But there is a lot of myths and misconceptions out there, Rich. And we talked about that a lot before, especially with like the VA loans. People hear things, or they have, my brother's uncle's cousin's dog said this, so it must be true. So here's the real case. Do you need 20% down to purchase a home? No, not unless you're buying like an investment property that's a 2-unit or 4-unit or something like that. So here's the options for you, and here's the reasoning behind it, which is even more important.
Mm-hmm.
If you're a veteran and are entitled to a VA loan, or if you're looking in an area and you qualify as well as the property qualifies for USDA, you could get in at 100% financing.
Mm-hmm. And the USDA program, besides it being very selective with the areas and everything, especially in Northwest Indiana, it's probably the best loan program out there because of all the terms and everything that they offer.
Yeah, USDA is a really good area, or loan program, I should say. And in fact, where we're sitting here, Rich, if we go about a mile south,
Mm-hmm.
Into Porter County, so
Mm-hmm.
south of Four Seasons, that is all USDA eligible area, all the way down almost to Lafayette. So Hebron, Couts, DeMott, all of those areas are USDA. They're a little bit more conservative as far as loan to value, or I'm sorry, the debt to income ratios and things like that.
Mm-hmm.
But it's an awesome program.
It is.
The other programs out there, conventional, there are some programs that are 3% down. Most conventional programs are 5%, but there are some 3% programs out there as long as you income qualify. And you can actually make too much to get in a particular area. And it's 80% of the average income. So I believe, I was looking at a couple areas in Lowell last week, and if you make more than $56,000 a year, you don't qualify.
Yeah.
So it's based on certain areas. But you could get a 5% out of them. And then the other program is the FHA, which is 3.5% down.
Mm-hmm.
But
Which is probably the most common loan right now.
yeah, FHA is a very common loan because it's government backed. They'll accept generally a little bit lower credit scores,
Mm-hmm.
and the mortgage insurance that's on there, the monthly mortgage insurance, is set. And so for someone with on a conventional loan, if they're only putting down 5% or 3% or 10%, they'll have monthly mortgage insurance also, but it's based upon your credit score.
Mm-hmm.
So if you have, say, 660 scores, the mortgage insurance might be more expensive. Well, it will be more expensive than if you have 760 or 780
Mm-hmm.
or 800 credit scores. So it really just we determine what loan program is best for you by more than just what the interest rate is. It's the total cost,
Mm-hmm.
because you could have a little bit lower interest rate, but if your monthly payment is higher because of monthly mortgage insurance, things like that, it's probably not the right program for you. So we're always looking at what your monthly payment is going to be.
Yeah, and I just want to say this, everybody out there, if you go and you find a house and you're very marginal with being able to qualify for a mortgage, but you do qualify, your mortgage payment will still be cheaper than what that house would be rented for at that point. So it makes all the sense in the world to buy a house, even if you have the bare minimum acceptance with into the FHA stuff with credit and debt to income and everything. And even if you're paying a higher PMI, private mortgage insurance and whatnot, it's still going to be cheaper than the rent for that property if you were to rent it. So just think about that.
Right. We talked a little bit about that last week too. and what the expectation is for housing price appreciation,
Mm-hmm.
things like that. But here's the thing you don't hear a lot of, Rich, when we talk about down payment, because it's always how much do I have to have down. And again, a lot of the myths and misconceptions out there is a lot of people say, well, you have to have 20% down, and that's not necessarily bad. And there's some of the financial gurus that you see on TV or you take their classes that say you should always have 20% down
Yes.
because you don't have to pay mortgage insurance at that point. Well, as long as you're in a conventional program, you don't have mortgage insurance
Mm-hmm.
with 20% down. But the question is, how do you get that 20% down? So do you rent for an extra 2 or 3 years to save up to 20%? Or do you move into mom and dad's basement to save up that 20%?
Mm-hmm.
So how long is it going to take you to get it? And then there's the cost of waiting. Because if it takes you another year or 2 years to get that 20% down, if if the housing prices appreciate as much as we think we're going to be, you could be losing money by doing that.
Well, if we look at how much the houses have appreciated in 5 years, a house, let's just say in Crown Point, that sold for 180 5 years ago, it's now selling in the 210s to possibly 220s now, on average. So in 5 years, it's the houses have appreciated a lot, and it's going to cost you more to buy the exact same house. So right now, it's sooner is better than later to get into that house. And I want to take another avenue here, and why 20% is not always a great way to get into a mortgage. A majority of Americans, we're in debt because it's easier than ever to get into bad debt and with credit cards and stuff like that. I can in the next half hour, if I went online, I could probably get 10 credit cards right now and go into debt. That much. So it's just way too easy to get into debt right now, and so therefore, should you use that 15% of that 20% to pay down your bad debt, which has extremely higher interest rate than a mortgage would? Probably. That would probably make good financial sense, and you're saving money in the long run. And I don't know about you, but I love saving money.
I agree. And it seems like those talks we've been having really seem to work.
And it's like I pick up on things, huh?
It's amazing. But you're absolutely correct. You're 100% true. Because look at it this way. If you're going to buy a $200,000 house
Mm-hmm.
and you want to put 20% down, that's $40,000. Okay? Or let's say, for instance, you did a 5% conventional. Now that's going to be $10,000. So the difference there between you financing 190 and 160 is $30,000.
Mm-hmm.
Roughly, you're looking at about $150 a month difference in your payment wise. Plus, there's going to be a little bit more mortgage insurance if you only put down 5% as opposed to 20, which would need it. However, if you're borrowing that money at 3%, let's say, and you've got credit cards out there, you've got $20,000 or $30,000 worth of credit cards, which I've seen before. It's not very common, but I've seen it before.
Mm.
But if you have that much in credit cards, think about how much you're spending just on interest to do that. So if your intention is to put down a larger down payment because you'll pay it off sooner,
Mm-hmm.
then what you want to think about is putting down a small payment and pay off some of those other bills, those monthly bills, so that your monthly outlay of cash, including your mortgage as well as your auto loans, student loans, credit cards, things like that, is going to be lower.
Yep.
And if you can borrow money, it's essentially what you're doing is you're borrowing it instead of putting it from a down payment. You're lending it to yourself to pay off other bills. Would you rather borrow that money at 3% or 4%, or would you rather borrow it at 16% or 20% or 24%? So it makes a lot of sense to do that, and it's just the way it can be structured. And we're doing that a lot with refinances right now, is showing folks how to take some of the equity in their property and pay off some of their higher interest rate debt to not only lower their monthly payment, but to lower the amount of time that they have to pay on the mortgage too.
Yeah.
So it really is, it's a win-win situation for everybody. But the thing is, even though it's win-win, it's not cookie cutter because each person has their own individual situation that they're in. So we really need to look at that.
Yeah.
So, if you want to put down 20% and you have fully funded your retirement for this year and you don't have any other bills and you have a 3 to 6 month nest egg if something happens, and you're sitting comfortably, absolutely.
Yeah.
Think about doing that. It makes sense. But if not, what's the best use of your money?
Yeah, it's pretty simple. The only people that should put down 20% without thinking about it are people that have absolutely zero debt. And other than that, you should at least entertain the ideas of, okay, if I do this to pay off debt, if I do that to pay off debt, is that better than putting 20% down? And it's something that you could easily sit down with your financial advisor to figure out which is the better option. Listening to podcasts and people on YouTube is probably not always the best idea because every situation is very unique. So there are standard principles that you should go by, as in paying off bad debt before good debt. Bad debt is a no word for like credit cards and stuff like that, where you can continuously keep charging it and paying extremely high interest rates and whatnot. So that's considered bad debt.
Right. No, and I'm glad you brought that up because when you say the word debt, a lot of people think that's a negative thing. That's bad. It's like, oh, debt. But there are different kinds of debt. Like you said, your credit cards, very bad debt because you don't get anything out of it. There's no appreciation. You go out and buy something from the store, or even say at the grocery store, you're borrowing money, paying interest on it to get groceries, but you eat those and they're gone. If you take out debt to buy an automobile, is it going to be worth as much as you paid for it or more than you paid for it in 5 years? Probably not on an auto. But if you ask that about housing, which is generally a good debt, because you can make money off of the money you're investing and have a place to live, generally, that's considered good debt. So we want to make sure we're defining those, and I'm glad you said that. Those, because there is a difference in types of debt. We have the good debt and we have the bad debt, and sometimes we use the good debt to help get rid of the bad debt.
Yeah, and though to me, and then let's subcategories the credit cards out. Store cards are probably the worst because when I worked at, let's just use Kohl's as an example, because in college I worked at Kohl's soliciting credit cards. So their interest rate was 22.9% on their. So if you apply for a Kohl's charge and get it, and to save 15-20% on your purchase, well, guess what? If you don't pay it off that month, guess what? You're paying what you saved. So it's a big game for the corporations, but as long you have to do it responsibly, of course. So there's ways to make money with store cards and whatnot, but it's a matter of doing it responsibly and keeping it paid off every month to make it worth it. And same thing with credit cards. I know a lot of people, myself included, that every single purchase I have goes on a credit card right now because I get percentages back. But guess what? It doesn't make sense if I don't pay it off every month. Then the money I'm making, I'm now spending on interest. So the main thing is it gets paid off every month.
Exactly.
So
you're right, and that's using the debt in a good way. Because again, we don't want to necessarily say all credit card debt is bad debt.
No.
But if you do what you do, Rich, instead of putting things on a debit card that pulls it directly out of your bank account, you put it on a credit card, and then you get the cash back from that. There's several of them out there. I know I've got a Discover card that does that. I have a Citi card that does that. It's 1% when you charge it and 1% when you pay it off. I never carry a balance, but every month when I get my statement, I look at it and it says how much I have in rewards, and you can use it that way. So we're actually making money by using those, which is a good debt. However, carrying a balance can quickly erase that good, the good that it's doing for you.
So yeah, so if you are using your credit cards, just make sure you do it responsibly, especially if you're looking to buy a home. Because if you show a history of great payments and it's not a carrying over balance, it's new balances and stuff like that, that makes a huge difference than a $5,000 maxed out credit card making minimum payments every month. So it talks completely different to the lenders.
Absolutely.
So,
It does.
but so other than that, do not put 20% down without weighing your options. Talk to your financial advisor. Talk to Scott because on your credit report it shows your debt to each credit card and whatnot, and he can tell you whether it makes sense or not from just looking at the credit report. And and then he may say, you know, why don't you go talk to an accountant? Why don't you talk to somebody that you trust about this? But just look from the credit. He can say, well, if this goes down, your credit score is going to go up, and you're going to get that much better of an interest rate also. So there's a lot of things to play out. So talk with your loan officer. Talk with your CPA. Talk with anyone that is knowledgeable with finance, and to help guide you if you're not. And it's a great learning experience, and you can learn how to game the system and improve your credit. So
Exactly. Yeah, and there's a lot of positive that we can take away from using credit, but it can also be very negative too. So very good, Rich. I appreciate you bringing that up to everybody. I think that's very helpful.
So, other than that, please, if you have any questions, please shoot me a message, comment below in the video, and we'll answer them in next week's video. Other than that, that is Scott Swinford with Hancock Mortgage. I'm Rich Sassman with Century 21, and I hope everybody has a great rest of your week.
See you, folks. Take care.
Take care.